95% options buyers lose money. But there is a smaller and smarter group doing the exact opposite. They're getting paid upfront and they don't care which way the market moves. Friends, today I will show you exactly how these three strategies are used by serious traders to make consistent, risk defined profits even when the market goes nowhere. Third strategy is very interesting, friends. You need less capital to take the trade. You don't lose money for time decay, but it helps you to make very good profits when the market moves in one direction. My new book, Options Trading Made Simple, is released with India's leading publisher, Jaiko Publication. I have taken some of the most complex option strategies and explained them in the most simplest and most practical way possible. The link is in the description. This book is also available in all the leading bookstores across India like Crossword, Oxford and even Swapna bookstores, and also in all the domestic and international airport bookstores across India. So without wasting much time, let's start. Friends, I have analyzed an interesting data. So what I did is I took the Nifty daily chart from 2015 till 2025 and I analyzed on which days Nifty has moved over 2%, which means above 2%. See, as per this statistics, so on Mondays, in the last 10 years, Nifty 2015 to 2025, on Mondays it moved approximately 34 or 35, greater than 2%. Tuesday, it is 20 to 22 days. Wednesday, very less, only 15. Thursday, 21. Friday, approximate 20 or 21. See what this indicates. So what this indicates is Nifty moving above 2% is a higher probability on Monday. This is bit interesting, right? I didn't stop at this level. So this is one more. This is Nifty moved 1 point above 1.5%, either upside or downside from 2015 to 2025. So once again, Monday is leading the rally, close to 65 or 66, and next is Friday. And Wednesday is the least. Even if you remember 2%, Wednesday is the least, and even for 1.5%, Wednesday is the least. So next is Tuesday and Thursday. So basically, Nifty moves or Nifty gives trending moves on Monday, higher probability. Next is Friday. I didn't stop my analysis here. Check this. So this is whenever the Nifty moved above 1%. Once again, the data is from 2015 to 2025. Once again, Monday leads the pack, right? It moved over 120 125 days actually on Monday. The next is once again Friday. So in this case, Tuesday is lesser and Wednesday, next is Thursday. So a simple clue, you might ask me, Indra, what is the benefit of this? The logic is very simple. Let's say you are a person who deploy non-directional strategies like Strangle or Iron Condor. Then it makes sense to deploy those strategies in between or in these 3 days, right? Because instead of deploying it on Monday and Friday, if you deploy it on these 3 days, there is a higher probability of making profits, right? At the same time, if you are a directional trader, okay, so you can take more risk or you can deploy your directional trades as per your system, not blindly. Okay, so as per your system on Monday and Friday, right, you can take little that extra risk on Monday or Friday because there is a higher probability of Nifty giving the trending days above 1% or 1.5% or 2% higher on Monday and the next is Friday, right? This sounds interesting. One more statistics. So this is bull versus bear. So this green color indicates the bullish move above 1%, whereas this red bar indicates the bearish move above 1%. Once again, I have plotted from the days perspective. Once again, the data is from 2015 to 2025. So if you look at this, once again, it's very clear that the trending moves comes on Monday, and bit surprisingly, the bearish move probability or the occurrence is higher on Monday. Okay. So, and if you see it here, Tuesday, Wednesday, and Thursday, I mean, Tuesday, it's almost bullish move is a very, very high probability. I mean, it's a past occurrence actually. It's not a probability, it's a past data actually. So Wednesday, once again, the bullish is higher happened. Thursday also, and even on Friday. Okay, Friday is almost, both are almost same. So does it give any important statistics or important point which validates or supports your trading system? I will leave it to you. But in this video, what I do is I will explain three important option strategies used by big players, big traders, which will be beneficial to make profits in different types of market condition. Okay, so let's go one by one. The first thing is short strangle. Most people are aware of this, right? And you might think, what is the necessity of knowing this? I already know short strangle. That may be true, but you don't know how to increase the profit and the success probability in short strangle. I'm going to explain few methods using you can increase the success probability as well as the profit in short strangle strategy. So basically the short strangle strategy is very, very simple. Let's assume Nifty's current market price is 25,000. So what we do is we sell downside 24,700 put option, 300 points away, and at the same time we sell 300 points upside, 25,300 call option. Okay, so when we sell this, let's say today is the Thursday expiry. Okay, assume today is the expiry. I'm selling this 25,000, 24,700 call option, I mean put option, 25,300 call option in the morning. If Nifty expires within this range, so whatever I sold, let's say I have sold it for 25 rupees. So I sold this 24,700 for 25 rupees and 25,300 for 25 rupees. So in this case, if Nifty expires within this range, then I will be pocketing both of this premium. That is the profit. For example, in this case, 50 into 75, how much? I will leave it to you. Okay. So this is the profit per lot according to me. So to sell one lot of Nifty, I mean, in this case, the two lot of Nifty 25 into 25, right? I mean, basically this is one lot because I've combined here. So approximately, I need around 1.1 lakh to 1.2 or 1.3 lakh. So this is the profit if Nifty expires within this range, right? Now, a small payout graph, okay? And usually the stop loss rule, how people play the stop loss rule is, let's say this is the thing they have sold for 25 rupees, call option 25 rupees and put option 25 rupees. So what many traders do is they keep a stop loss at 2x or 2.5x. Some people they keep at 3x, 1x, depends. So the simple idea is if you sold at 25, so you can keep a stop loss at 50 rupees. That's mandatory. The maximum you can go up to 60, 75, but you should keep a stop loss anywhere between 50 to 75 for both the call option and for both the put option. Okay. So if Nifty expires, as I said earlier, within that range, then this 25 becomes zero and you will end up making profits for both the legs, right? Suppose if Nifty moves in one direction, let's say Nifty moves upside, then the call option premium will be increases, right? And it will hit your stop loss. Okay, let's assume you have kept the stop loss at 50 rupees. So this will hit your stop loss. So whenever this happens, what traders does this here, the put option premium would have reduced to 12, 15 or 12 to 15, right? So they bring it to 25 and they keep it here. Okay. So because 25 is the sold leg price, right? We sold at 25. And in this case, if the price keeps on moving the same direction, this put premium becomes zero and you end up making, break even, So basically what they do is if the Nifty, generally 80% of the time we get sideways move, right? And market trends only 20% of the time. So if you follow this rule, what happens is 80% of the time your premium on both the side becomes zero, and 20% of the time it trends. Whenever it trends, you don't lose much, it will become a break even trade. That is the idea of the short straddle. I'm not saying it will work as it is, but that is the basic idea of the short strangle. Now there is some risk actually. Okay, so the first risk is it can hit the stop loss at open. Why? Because many traders they call it, or they suggest it as 920 strangle or 920 straddle, right? So whenever you take a trade at 920, the price can move in one direction. For example, what happens is, let's say you have sold something at 25 rupees and you have kept a stop loss at 50. You have done it at 950. So now what can happen to the price is it can go up, because open action will be little volatile, right? It can go up, it can hit your stop loss, and then it can become zero. So this can happen actually. Okay, so this will happen. This happens many number of times. Many traders have experienced this. So this is one risk with the short triangle. And the second risk is it it fails in a trending day. So when I say the trending day, many number of times what happens is, you know the price is like this, the Nifty is here like this. You have kept a stop loss. For example, you have sold both the legs at 25 and you have kept a stop loss at 50 for both the call option and put option. So what can happen is Nifty displays a sideways move. What happens is it goes upside like this, it comes back downside like this, again it closes here. Whenever Nifty displays this kind of structure, this is also called as neutral day in market profile terminology. So whenever Nifty displays this kind of structure, it will hit the stop loss on both the call side. It will hit the stop loss on put side as well. So even if you trial the stop loss, it will hit. So whenever this happens, you end up losing money, right? And if ideally the neutral day will occur very very rarely, especially at important support and resistance level, or at important resistance level, or whenever the market turn volatile, or whenever the big buyers and big sellers start fighting with each other. But nowadays in the changed market structure, we are witnessing neutral days very very often. And because of this, it is hitting stop loss on both the sides. So this is another major risk with short strangle. The one more risk is IV expansion after entry. Let's say you've taken an entry, and if there is a war between two countries like India and Pakistan, or if Trump make any new announcement, that's very very common nowadays, IV can expand. And recently I've noticed one more a strange factor in India. Whenever earlier, what used to happen is whenever the Nifty falls, IV India VIX used to go up. But whenever the Nifty used to go up, India VIX stayed constant or it was falling. But nowadays, even when the Nifty is going up, I have noticed India VIX goes up actually. So that's a strange thing happening in the recent market condition. And whenever you take the trade, after you take the trade, IV can expand and it can increase your premium, and there is a possibility of hitting your stop loss. These are the risks. So how do we mitigate this risk? So there are many important things are there, strategies are there. I have explained around 5-6 important techniques or ideas to overcome or improve the results of Strass Triangle in my book Options Trading Made Simple. But don't worry, I explain one or two techniques in this video. For the remaining techniques, you have to buy the book. It's a there is no free lunch in this world, right? In this book, I've explained very clearly with some of the examples. So you can buy the book to know more, or to know additional 2-3 strategies. But in this video, I'm going to explain two important techniques to overcome or to improve the results of short strangle. Okay, so number one technique is instead of taking an entry at 920, usually many people end up taking entry at 920 or 930. I suggest to take the trade at 945. You might ask why, what is the reason, Indra? The reason is very, very simple, friends. Don't trust my words as it is. You go to Nifty, check the price action in between 9:15 to 9:45 or maximum 10. Okay. So, most of the cases, the market will be volatile in this period. Okay. So, when you sell at 9:20, there is a high possibility of volatile moves and there is a high possibility of hitting your stop loss. But whenever you sell, in between 9:45 and 10 a.m., definitely the premium value will be reduced. You end up making less profit. There is no doubt about it. But at the same time, you don't get this volatility. Okay, it will be a smooth ride, smooth premium decay in most of the cases. So whenever you get these kind of trades for many days, automatically your profit increases, right? I can show you some of the some days. Okay. See here, for example, this is a Nifty 50-minute chart, right? See the first three candles represent 9:50, 9:30, 9:45, right? See, the market is volatile in the first three candle, right? See, after that, it completely here to here sideways. So your premium would have decayed by, know, maybe 25 to 75% based on the day, right? If it is expiry day, it would have reduced by 70-75%. If it is, one day after the expiry, maybe 10 to 25% decay would have happened, right? So you can check this day also. For example, first three candles till 9:45, it displayed a random move, right? But after that, it completely sideways move till here. Even here, it is sideways move. Okay, so you can check here also the first upside, downside. The first 3-4 candles are volatile, right? But after that, it is completely sideways. See here, it is volatile here and then it's completely sideways. Only the exception is at the end. By the way, I don't suggest to, you know, if you are an intraday option seller, I don't suggest to keep the trade till the end. Okay, 230, 245 is the higher probability. And the only exception is BTST trading, which I'm going to cover in the next few slides. Here also you can see the volatility is in the first 3-4 candles, then it's completely sideways. Here also you can see 3 candles volatile, then remain sideways. Here this is an exceptional day, so it's okay. Here 3 candles, then complete sideways. See here 3 candles upside, downside, upside, and complete sideways. See, if you have taken a trade at 9:20, it would have hit your stop loss on both the sides, right? Here also, 4 candles actually, then it's completely sideways. Here also 3 candles, here it's more actually. And here also 4 candles and then slowly it moved upside. See here also 3 candles, right? I don't want to get into too much, but what I'm trying to convey to you is, what I'm trying to convey to you is, so whenever you take a trade in between 9:45 and 10 a.m., there is a higher probability of success instead of 9:20 a.m. Okay, that is number one rule. This is an important technique. And one more important technique is you can use 1 DTE instead of 0 DTE. So what is the meaning of 0 DTE or 1 DTE? So DTE stands for days to expiry. So 0 DTE means if the Thursday is expiry, means you are selling or you are deploying short strangle strategy on Thursday itself. That is 0 DTE. Now, two things. So number one is, nowadays we need more margin. For example, LAM, right? If I remember correct, it's called as LAM. We need little extra margin to do short strangle on the expiry day, right? So that is one thing. And second thing is, and sometimes on expiry day, the market will be volatile. So instead of deploying short strangle strategy on expiry day, that is on Thursday, you can deploy it on Wednesday itself. So in this case, what happens is, this is especially if you are an intraday trader. So what happens in this case is, you don't need LAM, right? So you'll be able to take more position on Wednesday if you deploy on 1DT. That is number one advantage. And number two advantage is, definitely the volatility will be less compared to the expiry day, right? Because Wednesday, as you see the first slides, the movement 1%, 1.5%, 2% is very, very less on Wednesday actually. So if you deploy the strategy on Wednesday, from the probability perspective also, you will be safer. and from a margin perspective you need less margin, and from volatility perspective you are safer. And the advantage is, even, I mean, except the Thursday, the Wednesday time decay is higher compared to Monday, compared to Friday, compared to Tuesday. Time decay is higher on Wednesday. Only the decay will be higher on Thursday, but except Thursday, Wednesday is higher. So you will also get the benefits of time decay. Okay, these are the two important techniques you can deploy in short triangle strategy to increase the profits. Similar to this, I've covered three more, if I remember, two or three more strategies in my book. So to know more, you can read my book. Next, there is a risk. Okay, now many traders, they take intraday position and they end up carrying overnight, right? They become an BTST, and in the current market condition, it also makes sense to take BTST trade. Even in my case, I also take intraday trades, but nowadays I take more of a BTST trades because I'm an option seller now. So I my trade, it starts somewhere between Tuesday to Thursday. Okay, I hold between Tuesday to Thursday. Sometimes I take Monday evening itself, and definitely I don't carry on Thursday after 2 o'clock. Okay, because most of the time premium will be very less after 2, and I don't want to get into or I don't want to play that gamma effect which comes after 2. So by 2 or maximum 2:30, I will end up closing my position. So now the question is, if you deploy or if you take short triangle strategy, there is an overnight risk, right? If the price can display 5% gap up open, or 5% gap down open. So all these things can happen when you take the short triangle strategy, right? So there is a possibility. The simple reason is, for example, let's say the Nifty is at 25,000 and you have sold 25,500 call option, you have sold 24,500 put option. But what happens? I mean, from here, the unlimited risk starts, right? And from here, the unlimited risk starts. What happens if there is a war between India and Pakistan and Nifty opens at 24,000? So you end up losing or bleeding more money with this position, right? So that's where, short triangle works fine, or it's a wonderful strategy for intraday trading. But if you are a BTST trader or if you're carrying overnight position, then it is not a good strategy because of the overnight gap risk. So now such kind of people, what they can do is they can deploy iron condor. So iron condor is very simple. You had this position, right? You had these three position. So what we do is, for example, this is just an example, okay? So we had this position. Now we end up buying 26,000 call option, and we end up buying 24,000 call option. So in this case, what happens is, any open, even if the market opens at any level below this, even if it opens at 20,000, 22,000, you don't lose more money because the loss is capped because this leg will be increasing, right? The premium of this leg, because this is a buying leg, the premium of this leg will be increasing, and it will cover up the, I will not say more majority, most of the losses actually. Similarly, if the price opens anywhere above this level, for example 20,000, 27,000, whatever it may be, so this leg will cover the losses, right? That is the idea of and these are the two additional hedge legs, but combining these three, short triangle with these two additional buying leg is called as iron condor. Okay, so the number one advantage of iron condor is there is no gap risk actually. Okay, so the gap, you don't have to worry. That is one thing. And second thing is, it reduces the margin. Okay, because you have this two buying position, right? This one and this one. So your broker allow you to you take the trade with lesser margin, so you can take more position. Okay, that's second advantage. And the I don't say advantage. The third interesting point is, you need to. You end up paying little premium, right? Because these two doesn't come free, right? You end up paying little premium, so this can reduce some of the profit, but you don't have to worry about it because of the reduced margin benefits. You can take more position, and that that loss, you can, that premium you can easily cover with this. Okay, so that is the advantage of the iron condor. Okay, so you can do, if you are an, the logic is very very simple. If you are an intraday trader, you can do iron, short strangle. If you are an BTST trader, if you're carrying position, it is better to go with iron condor. Now, both short strangle and iron condor are non-directional strategies, which means you end up making more money when the underlying instrument like Nifty moves into sideways mode, right? See, for example, this is just a simple example. Don't worry about the too steep in the loss, because I just took a random example with the round numbers. See, basically, if Nifty sustains within this range, means you end up making profit. Your loss starts when the Nifty starts moving from this level, actually from this level. Okay, so that's what it's this payout graph indicates. Now we can take some of the examples. When I take some of the examples, you will understand it in a better way, right? Now, let's say the current market price is, it's somewhere around 24,800. Let's assume it's 24,800. So I will today is Wednesday. The time of recording this video is Wednesday. I will deploy non-directional strategy like a short strangle. So now 24,800, right? So what I do here, I will select options. I'm just taking an example, okay? So today I will select the tomorrow expiry day. So 24,800 is the current market price. So what I do is, for example, I will deploy 25,200 call option. I sell it. Okay. Now similarly, 24,400 put option, I sell it. So now what happens is, this is how, this is the short strangle strategy. Let's say if today is the Wednesday, it's not an expiry day, tomorrow is the expiry day. Let's assume if I'm selling this at tomorrow, if the Nifty closes somewhere in between these two leg, then I would have made the profit of this. Always don't go with this number, always go with 1.27%. So I would have made 1.27%. So otherwise, even if you consider today is Wednesday is 1 DTE, still there will be a decay. Let's assume somewhere Nifty closes at this level. If not 1.27%, definitely the premium will reduce. Maybe it will come down by 7-8 rupees here. This will come down by 7-8 rupees. So definitely I will make maybe 0.5% or maybe 0.75% returns actually. Okay. Now, this is from short strangle perspective. Now, to convert iron condor, let's assume, see here, we need around 2.25 lakh rupees to execute the strategy, right? Now, there is a risk. Let's assume I will carry this position as it is for tomorrow. What if, once again, there is an India-Pakistan war starts, and if the Nifty gaps down by 1,000 points? For example, when I say 1,000 points, the price is here, right? So 23,800. If it comes here, 23,800, see somewhere here, I lose around 42,000 or close to 45,000 rupees, right? That's a risk actually. So I can mitigate this risk somewhere buying this leg, and buying this leg. At least downside, it is mandatory. Usually, price opens with a view gap. Very, very rarely it happens, unless there is an event like a budget or Fed rate, something like that. Otherwise, usually it will not display such kind of big gap up open or big rapid movement. So downside, definitely you should have a leg. So what I can do is, for example, it's somewhere here, right? I sold 24,400, right? I will buy maybe 24,000 put option. I will buy. For example, what I do is 24,000, 24,000, right? 24,000 put option I will buy. So this is not a complete iron condor, because I have bought the hedging leg only towards the downside. Okay. So in this case, even if the CIS opens somewhere here, even if it opens any level before or below 24,000, I don't lose much. The loss is capped. 27,000 is the maximum loss, right? Okay, see here the maximum loss, it's somewhere uh, 27,000. The unlimited gas, I mean, the last scenario is only on the upside actually. Okay. So now it's not a proper iron condor, but definitely what I suggest to you is if you are an, you know, BTSC trader and if you're taken a short strangle, definitely I suggest to uh, go for a buying and hedge leg on the downside because market falls with fear. It goes up very slowly. So I suggest buying a hedging leg at downside. Now the proper iron condor is you can buy the same thing at upside. For example, if I buy 25,600 call option, then this becomes a proper iron condor. You can see the probability of profit is 77%. The maximum profit increases, right? It was around 1.4% if I remember correct. Now it went to 2.26%. The capital requirement also came down, right? See, earlier it was around 2.25 lakh for one lot. Here now for one lot it is only 1,06,000 rupees. So in this way you can take the double quantity, right? But again, you should remember if there is a loss, you end up making more money. You should also aware of it. But definitely, whatever the premium you are going to pay for this buying leg, it will cover. You can easily cover if you increase just one lot. Let's say earlier you were taking 10 trades, 10 lots. Now if you take just 12 lots, automatically it will cover the premium of these two buying legs, right? But it definitely gives the ultimate cushion if there is a big loss. It prevents all those kinds of scenarios, right? So that's an one advantage with this. I can also explain with the stock. For example, let's say I go to Reliance. If I go to Reliance, the same thing. For example, it's trading around 1,400 something. So what I do is I go to builder again, or I will reload page. I go to Reliance. I'll go to Reliance. I'll go to options, and then I'll select. This is a monthly expiry. There is no weekly expiry in in the stocks. So now currently market price is 1,430. I will select maybe somewhere around 1,500. Call option I will sell, not the buy. I will sell. Similarly, I will sell somewhere around 1,430 or the current market price. I should sell 1,360 or 70. 60 is fine. If I sell, see, this becomes a short strangle. The probability of profit is 88.7%. Within 8-9 days, the maximum profit is you can make 1.94% ROI. That is the ROI. So you can convert this as an iron condor, or you can also, but you can only buy the put option leg. That's also possible. Let's say I've sold 1,360 PE, right? So what I do is I will buy 1,300 PE. Yes, I will buy this. Even if I do this, this is the prevent leg. Even if I buy this on the call side also, it will increase this everything. For example, I can buy 1,560 call option. Now this is a kind of proper iron condor. 88% probability, 2.1.8% is the ROI. Capital required is only 68,000. Okay, so this is iron condor. I hope you got more information about the short strangle and the short strangle and the iron condor. Now, definitely I'm going to cover how to deploy these strategies in the intraday market. But before that, I want to cover one more strategy, which is highly beneficial for directional traders for both intraday level and BTST level. Now, remember, this is the data I displayed. Nifty moved over 1%. No, this is data from 2015 to 2025. It's higher on Monday, higher on second is Friday. It's in between is lesser, right? So what you can do is either short strangle or iron condor. So if you have a dedicated system or a trading concept to differentiate a trending move from the sideways move. So then you can deploy those two non-directional strategies on this day, right? You can deploy on Monday 3:30 or maybe Tuesday market opens 9:45. You can hold till Thursday 2 o'clock, right? From probability perspective also, uh, Nifty moving above 1% is higher, I mean lesser on these 3 days, right? So this is how you can collect the data, analyze the data, and you can use it, and you can pick a proper option strategy or a trading strategy to make the profits. Now, one more example is credit spread. See, credit spread is highly beneficial uh, if you know the direction. Let's say Nifty, Nifty moves, sideways to upside, or it will moves upside. In that case, if you do options buying, you end up losing money because of the time decay, right? Because time decay eats your profit, so you end up losing money because of the time decay. But at the same time, you want to make profits. So in that case, what you can do is, you can do this bull put credit spread. Okay. So basically, let's assume the Nifty current market price is 25,000. Let's assume Nifty is at 25,000. Now you think it will go to sideways to upside. That's your idea. If Nifty moves like this, then it makes sense to go for options buying. But you are not anticipating this move. You're anticipating sideways to upside move. So in that case, what you can do is you can sell. Okay, you can sell 24,800 put option. Let's assume the premium is 40 rupees. Now, to do this, I mean, this will cover, this is, when you do this, time decay works in your favor, right? Because you're selling 24,800. Now, to get more margin benefits or even for hedging perspective, so what you can do is you can buy 24,700 or 24,600 or 24,500. It's up to you, okay, based on the premium. Suppose if you sell, if you buy 24,700, the premium is at 20. If you go to 24,600, the premium may be at 15. If you go to 24,500, the premium may be at 8 rupees or 10 rupees. So it works like that, but the risk is also increases. Okay, you should know. Uh, 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 Basically, if you do this, for example, let's say 24,800 you sold at 40, 24,700 you bought at 20. So now the difference is the profit, right? 40, 20, because this is a selling leg, this is a buying leg. Both become zero if the Nifty stays above 24,800 till the expiry, right? So in this case, your profit is 1,500 rupees per lot, right? Okay, so this is per lot actually. Okay, so now, what happens if Nifty comes downside? Okay, if Nifty stays above 24,800, definitely you make this profit, right? But what happens if Nifty comes downside? Okay, so there is a loss is limited in this case. It's approximately 6,000. How the loss is calculated is maximum loss is the difference in strikes. Earlier it was only 100 points difference, right? And the premium. Okay, so the premium was how much? The 20, right? The 20 was the premium difference. 40 minus 20. So now if you do this, this is 80. 80 into 75, 6,000 loss. So the loss is limited, okay, in this case. So that's why I'm saying you should deploy this credit spread strategies whenever you have a more clarity about the direction, okay? So also you don't have to wait until the price hits to this level, right? You can have a stop loss. For example, let's assume you sold 24,800 at 40. You can keep a stop loss at 50, or you can keep a stop loss at 60, right? So in that case, you don't lose this much of money. That's how you can manage, okay? So that's about credit spread. Now, how to when to use credit spread. So whenever I explain this credit spread, many people, it's very unfortunate, and I feel very sad to say this. Many people don't know the real potential and the power of the credit spread. So they think it is just similar to option selling, or they deploy it in a wrong market condition only to lose money. Okay, so I will do one thing. I will go to charts, then I will explain how to deploy it. So as per SEBI, I'm not supposed to talk about the recent market conditions. So I go to Nifty. Basically, what I do is I'll go little behind, so then I can explain this. So basically, you should remember two things, friends. There is a concept called as open placement and also called as open auction. So open placement is nothing but where the price opens today with respect to the previous day close. Okay, so that's called as open placement. Okay, see, for example, I'll bring this. Look for a particular example. Okay, okay, so see here uh, here this is the previous day close, right? This is the close. Now price opened here, right? So this is open placement. Okay, so if the open placement is positive, which means if there is a gap, so it is bullish. If there is a gap down, it is bearish. If there is no gap, it is neutral. Okay, now I will tell you one simple technique. Okay, let's say this is previous day range. The price did this movement and then it closed here. Okay, so this is the close. Now next day price opens here, exactly opens at the same level, which means there is no change in the market sentiment overnight, which means there is a high possibility of price staying within this range today as well. Okay, so this is, you can check this. Okay, this is one thing. And the second thing is, I'll clear this. And second thing is, if this is previous day range, price close somewhere here, but price opens here. So open placement is positive, but what happens in open action? So even after the 2-3 candles, if the price stays upside, it didn't enter this level, means open auction is also positive. So in that case, there is a high possibility of price displaying sideways to upside. Okay. So in that case, you can take this credit spread, right? You can sell somewhere this leg, you can sell, you can buy somewhere this to make profits. Now I will go with some of the examples so that you can understand it in a better way. For example, this is the one. Okay, see here. So this is the previous day high, right? This is the previous day low. Okay, this is the previous day, this is the so this is the previous day close, right? So now price opened almost exactly, but little gap, right? Little gap. But if you remember, the trend is upside, right? And this displayed an, a kind of bullish candle. It's like a bullish pin bar or a hammer. Okay, so now what you can do is, when you see this or after this, definitely, because it broke the previous day high, right? It's like a proper breakout. So I, after the completion of this candle or after the completion of this candle, so what you can do is, you can sell this 23,200 put option or 23,100 put option. You can buy maybe 22,900 put option, right? So this is a selling leg, this is a buying leg. This is a directional trading. This is a directional strategy, like credit spread. So let's assume if this is Thursday, by end of this becomes, both becomes zero, right? The difference you make profit, right? Because let's assume if this is 40, this is 20, you end up making 20 points profit per lot, right? So this is one simple example. I will cover a few more examples. Okay, I'll go a little backside. Same thing here, also same thing happened here, also kind of same thing happened. I'm looking for a different example. Okay, uh, see here, the same thing but opposite side, right? The gap down open, the trend is downside, and after this you can deploy, you can sell the call option of this and you can buy the call option of this. Both will become zero. The difference you make profit, right? uh, See here, this is an interesting day, right? This is an interesting day. See here, for example, uh, so this is the previous day high, right? And this is the previous day low. Not this, maybe somewhere here. Okay, this is the previous day low. So this is the previous day close, right? If you see here, price opened very, very close, right? Price opened very, very close. And this is not a bullish candle. This is not a bearish candle. It appears like a bullish candle because of the green color. But if you observe the candle very, very closely, so close to 60% is 50-60% is selling, 50-60% is buying, right? So which means both buyers or sellers are equal in this case. And this is a balanced open placement is neutral because there is not much gap. Open auction, the first candle is also neutral, right? So which means there is a high possibility of price staying within the previous day range. That's what happened on that day, right? If this is Thursday or Wednesday, what you can do is, you can sell this put option, you can sell this call option, you can keep a stop loss at 2x, and you can hold the trade. Higher probability you end up making profits for both the legs, right? So this is one example. uh, do you need some more example? See, for example, this is here. there is a gap down open, right? This is the previous day close. There is a gap down open. See, which means open placement is negative. Okay. So now immediately we don't sell, right? We wait for the first candle. See, first candle, it appear like a bullish candle, but again, 30-40% is selling, right? But still we don't sell it here because at least we wait for the completion of this candle. Once the second candle forms, which means at 9:45, we have a clarity. Open placement is negative. Open auction is also negative. After the completion of this candle, you can sell this. Okay, you can sell the call option of this, maybe 22,900, and you can buy another like 23,100 somewhere. You can buy by end of the thing. If it is Wednesday, Thursday, you make nice profits, right? I think I've covered more examples. Let me know if you want me to cover more examples or you want me to make in detail videos like this in the comment section. I'll think about it. So now money management. So this is very, very important, friends. Your idea or your trading skill or your strategy doesn't make you profit, friends. So you should follow money management rules. So one simple rule is always risk 1 to 2% of your capital per trade, which means if you have 10 lakh rupees, you should not lose more than 10,000 rupees per trade. That's one thing. And also stop loss is mandatory. Even if you do intraday trading, you should place stop loss rule. If you do BTST, hedge leg is very, very mandatory. And don't lose or don't take more than 2-3 trades per trade, because whenever you take more than 2 or 3 trades per day, if you lose it, basically you lose 3 to 5% of your capital. But apart from it, you will get into the revenge trading mode, because in a normal mode you don't lose money. People lose more capital or entire capital in the revenge trading mode. That's what the third rule says. So if you follow these 3 rules, definitely you don't lose money or big money in the market. You stay in the game. Then it's all about improving your trading skills, improving or following proper money management rules to make profits in the trading. That's all for this video, friends. To know more about options trading, you can buy my book. So to know more, or we can meet in the next video with another useful content like this. So until then, thank you. See you. Bye bye. Have a nice day.